money markets watched for yesterday, the putting into public domain of the Monetary Policy Committee minutes indicating what each panel member thought about the inflation trajectory. Overall, it looked like everyone worried about the non-core inflation, the non-food inflation, services inflation. They worried about global impulses, especially a potential Fed rate hike or hikes, and of course global commodities inflation as well. Ananth Narayan of Standard Chartered Bank joins in to parse the key takeaways from the MPC minutes. Ananth, what did you take away? Today itself, bond prices have inched back just a bit. Do you get a sense of hikes or cuts from the minutes?
Well, I guess, Lata, to a large extent, the minutes just corroborated what we heard in the main policy itself. In the press conference post the policy, the RBI folks did, kind of elucidate what the thought process was, and the minutes stuck to that. So no real surprises in the minutes as such. But the fact that the market was taken by surprise by the change in stance, by the reiteration of the 4% CPI target, and by all this discussion on core inflation and output gap, etc., all that remains. There is a bit of a rethink happening in the market on the way forward. Now, I know the RBI is not very fond of analogies to birds, but unfortunately the market will see this as a hawkish MPC.
Okay.
And therefore the mood right now will be towards selling on rallies rather than buying on dips as far as bonds is concerned.
So if this is seen as a hawkish MPC, Ananth, first of all, good morning. Would you, rework your own inflation targets? I mean, the RBI still expects CPI to average about 4.5% in FY18. But what would your own targets be?
Morning, Sonia. So our CPI targets remain the same as it was before the policy, and we tend to agree with the RBI assessment that 4.5 to 4.6% for the next year CPI seems pretty much the base case scenario. One must reiterate, of course, that there is a huge amount of uncertainty around CPI projections, given 46% depends on food and monsoon. And plus, we have imponderables like the HRA component post the pay commission and the impact of GST whenever that comes through. So given all these uncertainties, 4.5, 4.6% sounds about right. But I guess what has changed is with the RBI reiterating its focus on taking inflation down to 4%, which we don't see as the base case, the probability of rate cuts in the immediate future has pretty much vanished from the market radar, which I guess is the change really as far as
that's what I wanted to ask. What are you looking at in terms of RBI action? Is it a full pause all through 2017? And therefore, what happens to the 10-year now? 6.92. What would be the range for the next 3 months?
Look, it does look like a long pause. While the RBI has reiterated that they want to maintain flexibility, which means anything, pause, cut and hike, I guess the threshold for a cut now has gone up quite dramatically, given they've just changed the stance to neutral. Seeing them come through with a cut immediately seems kind of improbable, unless we see a very, very sharp downtick in CPI, which we don't really expect. There is possibility of a rate hike also I would put as rather slim. Let's not forget the fact that this is probably going beyond demand issues really. While the RBI seems convinced that we need to manage demand to manage core inflation, despite the impact of demonetization, we are still seeing core inflation at sticky levels. And with credit offtake at 5%, with capacity utilization as low as it is right now, I'm not really sure a rate cut will be warranted. And I think CPI will behave itself. So to that extent, we do see an extended pause. The probability of rate cuts, of course, has diminished quite significantly. On the range of the bond, I think the longer end will remain under pressure. While 7% looks like a good level for the new 10-year bond, the appetite to take long tenor duration bonds at the moment will be limited. While we are not seeing too much of government supply coming through on the central government.
Uday bonds are coming.
Absolutely. So the state government bonds are coming. There is Uday bonds coming through. So that will keep the market on its toes. So don't really see appetite for long tenor bonds coming through. I think the short end will still be anchored. It's been a bearish steepening. So 2-year rates up by about 25 basis points, 10-year rates up by about 50 basis points. That trend will probably continue. So can we see 10-year bonds going up to 7.10? I think it's possible. But 680, 710 should be the range. At beyond 7%, I think it becomes attractive for banks to start buying 10-year bonds, given the fact that credit offtake is so low and we still have a liquidity overhang.
Ananth, thanks for stopping by and giving us your quick comments. With that, it is a wrap on Bazaar, but lots of sectors and stocks in focus. Do stay tuned in.